The following podcast was recorded on Thursday, April 14th, 2022, featuring Sam Rines of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Sam Rines of Arbor Data Science. Welcome, Sam.
Hey, Kristen.
Good to see you today. Today, Sam's going to discuss the significance of new, used, in the classic car marketplace. Sam, after the CPI report was released, headlines stated that used car prices are on the decline. Here's what we know. There's been a lack of new car supply brought on by the pandemic. There's been a chip shortage. But what are we forgetting about this market?
There's a few things that I think are being overlooked when it comes to the broad discussion of new cars, used cars, generally just across the board. The first one is that the new car market really isn't that big when you compare it to the used car market. And the used car market is 2.5 to 3 times on average the size of the new car market. I mean, it is a huge market, give or take 40 million vehicles a year versus 15, maybe 17 million in a really good year for new cars. So it's a massive market. So when you have price fluctuations there, it's going to be significant, and it's going to call it flow through in different ways that I think are somewhat difficult to parse apart unless you're really paying attention to the market. I mean, for instance, when you have a lack of new cars and you want a new car or a new-ish car, you have to go find one, right? It's not just, go to the dealership, haggle a little bit and drive away like it was in 2015, 2016. It's much more of a, do I want to overpay for a vehicle? I mean, everybody has seen those really interesting posts on Twitter or YouTube, wherever, that MSRPs are now being raised for a pandemic problem, right? So Porsche's going for, instead of 125,000, going for 350,000 or something ridiculous like that. So now, instead of buying a brand new vehicle or ordering one, people are going and buying a 1, 2, 3-year-old vehicle that's either come off lease or maybe been in a rental car fleet, et cetera. So it's a much different world, and that's helping to drive some of these odd price fluctuations, particularly on the margin.
And there's an interesting observation with the overall market for non-new vehicles, classic cars. The classic car market is rallying. After hitting a bottom in the middle of 2020, the classic car market has spiked. What's driving this rebound?
It's hard to tell exactly what's driving the rebound, but I think it's kind of an alternative investment in a lot of ways, right? So people either remember their first car, their dream car from when they were a kid, whether it was a classic Camaro or a Corvette or a Mustang. For me, it would be a Camaro. They remember what they wanted, and therefore they go out and buy it. And it's been a market that's been on fire. Granted, it did dip in 2020, or at least the beginning of 2020 and through the kind of the mid part of 21. But it has been on fire for the better part of a decade. And it's been really interesting to watch the way that people think about it. It's no longer, I'm going to buy this car and drive it around. It's, I'm going to buy this car, put it in my warehouse or put it in a museum and show it off. It's much more of an investment, almost like art, than it is a true car purchase. So that's been driving a lot of the market. And when you have ample liquidity, aka very low interest rates and a significant amount of fiscal spending happening, you tend to have investments do well. And classic car market has been an example of that. I would say kind of almost to a ridiculous extent.
And why does this market in particular really matter? What is it reminiscent of with the Fed?
What is it reminiscent of with the Fed? It's an interesting one, because it's reminiscent of when the Fed is loosening, you get these big rips off the bottom. I mean, and when the Fed's tightening, like it was from 2016 through 2018, 2019, you have a decline, right? So it's pretty much pretty much a chart of the Fed's balance sheet in a way, just delayed about 6 to 9 months.
We want to turn next to the core CPI print. It was pushed lower by used autos in March, but why did the core reading driven by used autos catch everybody off guard?
It's a great question. I'm not really sure why it caught anybody off guard. Particularly if you were just looking at the indexes that get published pretty frequently. I mean, Manheim had dipped by quite a bit. It almost was shocking that the used car reading for March and the CPI report wasn't lower. That was actually kind of intriguing to me, particularly on a year-over-year basis. That was almost, it probably should have been, it was minus 3.8%. It probably should have been closer to 5 to 7 in my estimation, just kind of doing the math off Manheim. And so it's one of those where you kind of had to look at it and be like, okay, yeah, that made sense. What was interesting was that none of the other components made up for the decline in used cars. That was kind of the shocking part, I think, to markets, was they were expecting a lot of things to run hot to make up for any fluctuations that might have happened within either appliances, which we should begin to see some declines there, but also used cars. That I think was why markets had core priced at 0.5% and not lower. But the used car market is going to continue to drive some downside here, at least in the near term, just on a makeup basis, so to speak.
And Sam, you have described the used car market, and I'm going to quote you here for a second, not only as a consumer-facing product, but a financialized consumer product with housing, but it's similar to housing, but with a much quicker reaction function. Can you elaborate on that?
Yeah, this I think is the other part that's overlooked way too often within the auto market is about 25% are on lease, and leases are basically just near-term interest rate problems. You're borrowing a car from the leasor, and that's going to be priced off interest rates. So you have that, and 80 give or take % of new car purchases are financed. That's just a fact, and it's somewhere between 15 and 20,000. On average for an outstanding auto loan on the debt front. So it's a market where it is highly financialized, and it's fairly interest rate sensitive. I mean, this is not a market that is going to do great when people all of a sudden, instead of being able to go out and get an auto loan at 2%, are going to have to go out and get an auto loan at 8%. That's a much quicker reaction and a much more visual reaction or visual influence from interest rates than housing. Housing, people don't buy houses all that often. We tend not to move that frequently. I mean, we do move on, 5 to 10 years, give or take, but people buy cars much more quickly and at a much higher frequency and have more cars than they do homes typically. That's a very important part, right? If you're going out and you're trying to buy a vehicle at $70,000 and all of a sudden, it's a 8% interest rate on that $70,000 vehicle for 3 years, you're either going to have to extend to 5 or extend to 8. That's going to begin to become a problem for the market as we move forward. So this is going to be one to really pay attention to. Not necessarily on the new car side, because we know that new cars are supply constrained. So there's going to be a lot of noise there. But it is going to be really interesting to watch how used car sales react to higher interest rates in April and May. That's one of the things that I think is going to be very important to see how constrained the consumer really is as we move into the summer months.
So in summary, Sam, my question to you is, what else should we be watching?
It's intriguing, right? So we've had a couple of really interesting reports. So we had CarMax report earnings this week, and it was pretty dismal, right? And that's a used car maker, and they said, hey, same store sales, their comparison of year over year sales were down in the mid single digits. They're like 4% of the used car market. They're a very, very large portion of it. That's going to be something to watch, is how's the consumer really reacting here? So I'll be watching the earnings reports, particularly those that are consumer facing. Delta had one of its best booking weeks earlier, or just kind of late March. Carnival had one of its best weeks late March. I'm going to be watching that consumer very, very closely. It looks like they're beginning to pivot towards services over goods, travel, leisure, that type of deal. I'm going to be paying very close attention to that, particularly with companies and their earnings reports, because consumers and their surveys, you can lie to a survey. You do that, and the SEC gets very mad if you do that in an earnings report. So I find those very, very useful for getting an idea of where the trends are heading as we move forward. So paying very close attention to that. And I do think that we're beginning to see a slow pivot towards services by consumers.
Well, thank you, Sam, for your thoughts today, and thank you, everyone, for joining us. As a reminder, we are client-driven. If you have any questions or feedback on future topics, please let us know. If you need any information on Arbor Research, Bianco Research, or Arbor Data Science, please contact Gus Handler at gus.handler@arborresearch.com. Have a great day.